Good day, everybody. David Ursino from Royal LePage Your Community in downtown Toronto, and today I'm here with James Harrison from Mortgages.ca. Welcome, James.
Thank you, David.
So today we're going to talk about mortgages. Obviously, James is here, and one of the things, the question we're going to answer is what happens if you put in an offer, say at $900,000, and your bank comes back and appraises it at $800,000? Then what? Do you panic? Do you not? What do you do? So, James?
Yes.
What do you think? So I know there's a lot of levels to this conversation. We'll tackle some of them. Ideally, we're gonna highlight some important points that you as an agent should know to open up a conversation with your clients, with your mortgage broker, to understand the process. So, house is sold for $900,000 that you bought with your clients, and it gets appraised at $800,000. Then what?
Yes. Well, the most important thing when you're going into that bidding war situation is first confirm the client is pre-approved.
Right.
That is important.
Yeah.
A client may be pre-approved for a mortgage of $1 million, but at the end of the day, the bank is the one buying the property.
Right.
They are the one financing it. So when you're making an offer with your agents and you're about to waive financing conditions, you want to make sure you're reviewing the comparable sales, and the offer you're presenting is going to be backed up by comparable sales, because the appraiser is also going to use ideally the same comparable sales, as long as they're within the last 90 days for a similar property, to determine the value. If the client is potentially paying more than the comparable sales justify, then they're potentially paying a premium for that property, and it may not appraise out. So in this example, it's a time where the appraisal did not come in on point.
Right.
As a mortgage broker, I would then reach out to the realtor, ideally before the offer goes firm.
Right.
Discuss the comparables a little bit, and the fact that the client may be going firm with their offer. In the event we order the appraisal right away and it does come in under, I would then talk to the appraiser, potentially provide those same comparables that the realtor used, and maybe try and contest it a little bit. Worst case, we go to another lender, get a new approval and a new appraisal done. If you're working with an experienced mortgage broker, they should have their own network of trusted appraisers that they can work with, and they can work hand in hand and provide the comparable sales and potentially get it up closer to at least what they paid.
Right. I guess we have to point out though that there's risks in that, in terms of, or the real estate agent needs to understand, first of all, if their client is putting down 20% or less, if it's a CMHC mortgage versus a conventional mortgage, and so there's some risks there. So in terms of having the home reappraised, perhaps a new lender and whatever, that'll work for you when you have a conventional mortgage. But if you are on a CMHC mortgage and maybe only 5% down, that's a different conversation, right?
Absolutely, and it's a great point. So if a client is buying a property with less than 20% down, it's an insured high ratio mortgage. So it's either insured by CMHC, Genworth, or Canada Guarantee. All of them have an automated valuation system. So when the broker or lender submits the deal to them, it'll go through the automated valuation system, whether it hits. And 9 times out of 10, it will hit. If you're paying...
Hit means positive.
Hit on the price that was paid.
Right, yeah.
If it's in one of those situations where it's listed for $600 and it sells for $800, it's probably going to hit a red flag, and it won't automatically appraise. So CMHC will then order a full appraisal. We have no control of the appraiser they use. They order it, if the report goes direct to them.
Right, so that's CMHC, no control. Be careful.
Yes.
Keep going, okay.
And like we were talking about a little bit there, if that happens and it doesn't auto appraise, the appraiser goes in for CMHC and it also doesn't appraise out, the broker or lender can potentially also send it to the other 2 insurers, Genworth or Canada Guarantee, to try and get an automated valuation. So you can take the process a little farther, but again, back to what we talked about, make sure you have this conversation with your clients prior to making a firm offer. They may be pre-approved for a mortgage greater than they're even buying the place for. But at the end of the day, the lender is the one buying the property. They need to confirm the value is there.
Yeah, absolutely. So someone could be approved for $1 million and they choose to buy a semi that's worth $700,000, but the bank needs to approve the property itself. The people are pre-approved, but the property itself needs to be pre-approved as well at a certain value. So
Yes.
that's an important distinction to be made as well.
Very.
We touched upon, well, I mean, you touched upon what agents should be advising their clients and all that. So that's a really important part of your role as an agent, is the conversation you have with your client. You need to open up this conversation so your client knows ahead of time that when they're going into an offer situation, and maybe it's multiple offers, and they're thinking of bidding over asking, for example, you need to have the conversation with your clients as to what happens when perhaps they bid over, and then the appraiser is going to have an appraisal that is lower than what was actually offered. And your clients need to know that, you need to know that, and you need to have an understanding of what their down payment is. Is it 5%? Is it 20%? Is it 50%? Yes. And each of those situations will have a different sort of resulting conversation and how you can advise your client. So for example, on the example that we started is, let's say $900,000 is the accepted offer and it appraises at $800,000. In terms of the actual numbers that the buyer needs to come up with in terms of extra down payment, what does that look like, James?
So basically it would be the difference in value. So you've agreed, you've gone firm at $900,000.
Yeah.
You have to pay $900,000. So it's appraised at $800,000. So now you want to do 20% down.
Yeah.
You're going to do 20% down of the $800,000.
So let's talk about it initially.
Okay.
So it's $900,000,
Yep.
right? And they want 20% down, let's say.
Yes.
So that would normally they'd have a $180,000 down payment.
Correct.
Right. Okay.
Yeah. So they were anticipating putting $180,000
right.
down.
So they have 180
down.
grand in
Yeah.
the bank ready for this down payment.
Right.
Right.
It's appraised at 800, and they still want to try and do 20% down.
Right.
So they'd have that for 800, which is of 160,000. But now they have to come up with the difference, which is 100,000.
Right.
900,000 accepted offer, 800,000 appraisal. So 20% down of 800 is 160 plus the $100,000 difference.
Yeah.
Now it's 260
Yeah.
to put down to maintain 20% down.
Yeah.
So if they have it, great.
Great.
If they can
Yeah.
come up with it, great.
Yeah.
Or worst case scenario, and they qualify, buy it for 800, put let's say 80,000 down, and then come up with a $100,000 difference, and now it's a total of 180.
180. So there's still that 180 down payment.
Still the same amount of money down.
But now they've reduced the percentage of their down payment, and they've
now
gone to
they'll
a higher
incur-
risk ratio.
Now
right?
they'll incur the high ratio insurance.
Right, exactly. So there'll be some extra fees for the high ratio insurance, obviously.
Yeah.
But see, this is what I mean about you having to understand their down payment, their mortgage math, and all that stuff. You need to understand if it's 5%, 20%, 25%, or more, so that you can make those calculations for them. And you need to know so you can advise them properly.
Yes.
Let's say, someone's buying a condo downtown. They are pre-approved for a certain number. They've got 5% down payment. There's 10 offers on the property. Should they go in firm, James?
My opinion, they are not the type of client to be going in firm.
I agree.
There's no room for error.
Yep.
They have 5% down.
And that's all they have. They don't have any
that's
extra
all they
savings. The
have.
bank of mom and dad is spent. That's
Yes.
it. Yeah.
So, you know what? As a realtor, as much as you want to get the deal done,
Yeah.
I totally get it. I do too. But that's not
risky,
the client that should be going
yeah.
in on a bidding war with 5% down.
Yeah.
They don't have room for error.
Yeah, exactly. So if you're an agent representing a buyer and they're putting down 5% or any other number, you need to know what that percentage is. You need to know how much they are willing to put down for a down payment so that you can have this conversation with them. It'll open up a whole bunch of questions that they'll have, but you need to be able to address. And when you're not able to, you can go to someone such as James to help you out with those numbers and those questions. We covered everything? What do you think? That was pretty good.
I think so.
Anything
That's
else?
good.
Yeah?
No, it's good.
Sounds pre-approved. Yeah. I think we got everything. Very good. James, thank you once
No
again.
problem. Anytime.
Have a great day, guys.